All right, we are live. Hi, everyone. Welcome to Market Matters. My name is Katie Kuntz, and I'm a social media editor here at CNBC. I'm joined by CNBC's senior markets correspondent, Bob Pisani, and today we're going to be answering all of your questions about the latest stock market moves. Nice to see you, Bob. I know you've been on the road a bit recently.
Hey, thank you, Katie. Yes, was in Miami for the ETF conference and was in Mexico for a week on vacation. My wife and I, our primary love in life is travel and experiences. So traveled all over the world and plan to continue to do so.
Yeah, I mean, I love traveling too. It's a great way to get out there, especially now that things are back and opened up. So I always love hearing about your trips. And first, today, we're going to actually talk about your recent trip to Miami. You were down there at the Exchange ETF Conference. So what did you learn, Bob?
Well, there were 2,000 people there, and I've never seen so many confused investment advisors. These people who go to these things, they're RIAs, registered investment advisors. A lot of them were, old Morgan Stanley or Merrill Lynch people, and they kind of struck out on their own as a registered investment advisor. And they have clients, and they make recommendations on asset allocation. And it's been a tough one because at the end of the 2022, everyone was kind of sour and thought this year, and the question was, how serious a recession was there going to be? We had a rally in January, so everybody was off sides, and now in February it's getting a little tougher to figure out. So they're very confused on what they should be telling their clients. And the long-term answer is you should have a long-term plan. You should certainly not be encouraging a lot of active trading. That's for sure, not in this environment. So the RIAs were really looking for some advice, and the simple advice is to have a plan and stick with it and don't try to trade your way out of it. But a lot of people are obsessed with the idea of providing a short-term narrative. So they want to go back from the conference and tell their clients, they might have, pick a number, $100 million in assets under management, and they want to tell their top 10 clients a story about what's going to happen in the next few months. And go ahead, but you'll find that the narrative on December 1st was different than the narrative on January 30th, and it's different, maybe slightly different narrative on February 30th. So it's a tough one right now.
So, Bob, we've gotten a lot of reports recently on inflation. What can we learn from those?
Well, unfortunately, the narrative isn't working in favor of the bulls. So the narrative for the start of the year was inflation is still too high, but it's coming down. What we call the glide path is it's still high, but it's slowly going down. And the recent reports have not helped that narrative. The basic idea here is they've either stalled out and are not going down, or today we got the personal consumption expenditure, which is an inflation report that the Fed likes to look at, and it didn't go down. In fact, it actually went up month over month. And that's a little disturbing for the bull case, and that's why we're actually down today. We're trying to climb out right now, but it's a tough narrative right now. So if inflation doesn't go down, it means the Fed will stay higher for longer. They will keep interest rates higher, maybe even higher than we think right now. They'll have another several rate hikes, and they'll keep them higher for longer. So the higher for longer narrative becomes more powerful if inflation doesn't go down. And that's what the stock market has been struggling with for the last couple of weeks. It's the reason bond yields have moved up, and it's the reason the dollar's moved up too.
So yeah, Bob, I was wondering if you could just talk a little bit more about, it's kind of the end of February now, where do we stand with the stock market these days?
Right. Well, you see how confused people are. So we started off in January with hopes that the inflation narrative was coming down, and it did well. And now the inflation narrative is sort of changing, not so positively for the bulls. So we're down 3%. The S&P is down 3% in February, but it's still up 3% for the year. So we have these lingering effects of hopes earlier in January, and now February, it's been a little bit tougher. This is why I mean it's a real roller coaster and very difficult to figure out. You don't trade your way out of these kinds of things. You have a plan. You're either, decide how much you want to have invested in the markets, how long-term you want to be in the markets, how short-term. If you're a tactical trader and you want to trade on a daily basis, good luck in this environment. It's just very difficult to figure out right now. So the it is very unusual. Remember, we were down almost 20% last year. It is very unusual to have 2 down years in a row. It doesn't happen very often. And so the odds that we will have a second down year are not very great. However, it's quite possible and easy that we could have a fairly nothing year. We could be flat or up just a little bit. So it can really go either way. Right now, the back end of the year, there's still a bet that the earnings are going to hold up very well, and we're going to have a either soft landing or modest recession. But that's still, you can make an argument for or against any of these positions right now. I would say the conviction level is not terribly high. That's a key word. How much does the valleys of opinion, does the consensus of opinion one way or another? And I would say there's a lot in all directions right now. Some people would say that's a good thing.
Well, Bob, that kind of leads into our next question, which is one that we get pretty often, is, what are the chances of a recession, and what would that mean for investors?
Well, I'll tell you why I don't like the question. It's not that it's not the right question. It doesn't mean that much. First off, it's very hard to define what a recession is. You can say it's 2 quarters where GDP goes negative. I don't find that very interesting. What happens is recession is kind of a state of mind for a lot of people where the economy slows down and you feel it. So you remember that old joke, a recession is when my neighbor loses their job. A depression is when I lose my job. So that's the way a lot of people tend to look at these things. If you're talking about a significant slowdown, we're not even close to that right now because the job market is so strong. There's still more job applicants than there's still more job offerings than there are job applicants. And so you can argue all you want about inflation eroding the purchasing power, and it does, and it particularly affects the lower end, and that's true. But if in terms of like a really serious economic downturn, we're not there. And that's why one of the reasons the stock market has held up so well, that it's doing so well. So I wouldn't worry. I wouldn't try to figure out whether we're in a recession. I would try to figure out the extent of the economic slowdown because you get caught up with definitions of recession. And right now, any economic slowdown I see is fairly modest right now. The key game here is if we can get inflation down more, that's going to be the good story. The problem now is that the market is starting to debate if these numbers don't go down, the Fed's going to keep raising rates, and that's going to induce a more serious slowdown, you see? So you're in this endless hamster wheel of arguing about the market, and when are we going to start moving up again significantly? And that depends on the glide path for inflation, and it's not cooperating. So now we're back to debating how much is the Fed going to have to raise rates to slow the economy, and are they going to throw the economy into a much more serious slowdown? We're back to that old hamster wheel story that we were doing 6 months ago. That's why the market's in a bit of a funk right now.
So, Bob, can you talk a little bit about where the bond market stands right now? I mean, we have 2-year Treasury yields at 4.8%, and they seem to want to go to 5%. So what's happening in the bond market?
Yeah, my mother called me a couple months ago. My mother watches bank CD rates, and she said, Robert, I went to the bank, and the CD rates are really good. And we started talking, and brought up, the bond market was doing well, and the yields were doing well, and should she invest, in treasuries now? Now, that's a tell right there. When your mother asks you about the bond market and CDs, that's a tell. That's like the shoeshine boy talking about the stock market. That's a sign that the average American are now really noticing that they can get a return on their savings, on their bonds. And what this means is that the bond market is becoming serious competition for the stock market. It's drawing money away. Remember, there's a pot of money for investing around. It's not infinite. And so people have money in real estate. Some people have money in the stock market. Some people have money in a savings account. Some people have money in bonds that pay a dividend. Well, these pools of capital compete against each other. Bonds have been terrible returns for more than a decade. Everybody hated bonds. Now, all of a sudden, there's yields out there. A 2-year Treasury yield is heading towards 5%. That's amazing. There's people out there who would say, why should I put a lot of money in the stock market when I can get a 5% yield owning risk-free 2-year treasuries. The government will give me 5% for the next 2 years. It's guaranteed. You're going to get the money back. Guaranteed. It's the federal government. Why bother investing in the stock market? That's serious competition now for the first time, but I don't think people have completely thought that through. So remember, when your mother starts asking about, CDs and 2-year treasury yields, that's a tell right there. Pay attention, and people are paying attention. By the way, I'm going to have a fellow on Monday on ETF Edge that specializes in selling treasury ETFs. If you want to own a 2-year, very simple, you can buy them from the government, but you can also buy it in the form of an ETF. You can watch etfedge.cnbc.com Monday at 1 o'clock and learn more about how to do that if you're interested in buying bond ETFs directly.
Yeah, that'll be a really interesting conversation for sure, Bob. So I'm sure our audience will tune in for that as well. And kind of going along with this, Bob, can you talk a bit about the relationship between the bond market and the Fed rates?
Well, the Fed sets short-term interest rates. The most important is the federal funds rate. The federal funds rate is the overnight rate that the banks will charge each other for short-term, literally overnight. So that's currently what the current rate is, but the Fed funds rate is pretty much up there right now, and that influences the prime rate that the banks charge each other, and it influences treasury yields. So normally, like the short-term treasury, which is 3.8% or something like that, that's normally is very close to what the Fed funds rate is. So it influences the prime rate, for example, which is what banks give their preferred customers. And the very short-term treasury yields, like the 3-month and even close to the 1 year, usually track or close to the Fed funds rate. So basically, the Fed funds rate sets the current pace for the whole game.
Yeah, definitely has very far-reaching implications. So Bob, our next question comes from our Instagram audience, and they were asking, what should investors consider when it comes to the balance of stocks and bonds in their portfolio? What do you think of that balance?
Yeah, I was just looking up I didn't have it in front of me here, but the current Fed funds rate is 4.75%, and the 3-year bill is 4.8. So you see the Fed funds rate, which is 4.75, and the 3-month T-bill yield is 4.8. So they're very close together, to my prior point. Mm-hmm. So about what investors should consider. Look, this is a really personal decision. I can tell you that if you're a young person, this is my personal opinion, I see not a lot of reason to own bonds. If you're 25 years old, I would have no hesitation recommending 100% portfolio in a diversified portfolio like the S&P 500 and a small cap fund. If you want to add bonds to it, you're interested, that's fine. But I would think bonds become a little more important when you get a little older. If you want to have a 75-25 portfolio, that's fine. Nobody's going to laugh at you. I didn't until much, much later in my life. And I've written a book about my experiences in investing and reporting about the stock market. Shut Up and Keep Talking, Lessons on Life and Investing from the Floor of the New York Stock Exchange. It's on Amazon. And I do something almost nobody ever does. I talk about what I own and how I've owned it and why I owned it and my whole history of investing since the early 1990s. And my current portfolio is 75-25, has been for years. 75% stocks, 25%, it's actually 75-20, 5% cash. And I have, I'm in my late 60s. I have never seen any particular reason to go to a 60-40 portfolio. Doesn't make sense to me. It seems like stocks long-term outperform bonds, not necessarily short-term. And there are periods for several years, everyone knows, when bonds did better. But generically, I'm a stocks guy, and so I tend to keep most in stocks. So it's something you have to figure out. It has to do with how old you are, when you want to retire, how much you're saving, how long you think your life is going to be, what your risk tolerance is these are questions you all have to ask yourself. But when you're young, I mean, when you're 25, 35, even 40 years old, I would argue strongly for a very heavy weighting of equities over bonds.
Yeah, and you definitely talk about that in your book, Bob, about your personal decisions with that balance in your portfolio. So very helpful information for everyone. Next up is kind of a more specific question about one company in particular, and that's Tesla. So what's your opinion on Tesla, Bob?
Well, I don't give stock advice. I don't do that. It's not my job. Tesla's had a wild ride this year. It was, a 2-year low in January, and it was at a 2-year low, not because the fundamentals of Tesla were bad. It was at a 2-year low because investors were terrified that Elon Musk was going to spend all his time trying to fix Twitter, which some people think could be fixed, some people think are some people think is broken, and some people can't figure out why he would give a damn, given all the other great things that he's doing. So Tesla, Musk's actions around Twitter greatly dismayed a lot of the Tesla investing community. What they want is they want him focused on making Tesla the greatest EV company in the world. And he did help make that happen. But now there's significant competition. It's not necessarily clear to anybody, even to Elon Musk, I think, that Tesla is going to be king of the electric vehicle hill even 2 years from now. It's not clear. And because it's not clear and because there's competition, the Tesla investors want him, because this is a belief in Elon Musk's story, they want him focused on making sure Tesla maintains innovation and is the king of the hill. And Elon Musk seems to believe that Twitter is somehow really essential to his identity or the identity of Tesla. And a lot of people have doubts about that, including myself. So I've said this many times. I think Elon Musk is the Thomas Edison of his age. Nobody else was able to pull electric vehicles out of the muck. Nobody else was able to create a company, SpaceX, with a super rocket designed not just to go to the moon, but to go to Mars. Nobody else was able to create a massive global telecom system, Starlink, which is now up and running and has tremendous potential. Nobody else had ideas like the Boring Company, dig holes and go underground and let's go. If there's a problem with traffic in Los Angeles, let's just dig a hole under Los Angeles and go around everything. Sounds like a crazy idea, but these are moonshots, and he's made moonshots palatable and even approachable. Nobody else has done that. So I'm a huge Elon Musk fan, but I'm dismayed too by how he gets into these rabbit holes. We want him focused on what he is best, which is being a genius and not fixing Twitter, which a lot of us don't frankly care about. So let's hope that Elon finds a CEO to run Twitter and he just goes back to being brilliant. I'm really excited about SpaceX. It doesn't get as much ink as it should. It's a tremendous company. And that valuation of that company, boy, that's an IPO to watch out there. I don't know where it is or what the thinking is, but that's an IPO to watch out there.
Yeah, for sure. Well, a lot going on there, a lot to watch in that space as well. Our last question, Bob, is we've heard a lot recently about things like ChatGPT and these AI chatbots. But more generally, Bob, what does the development of AI mean for the stock market?
Well, everybody's enamored with this ChatGPT. So for decades, I'm a science fiction fan, we've been talking about the implications of artificial intelligence in science fiction and short stories for decades. And it's finally here. There is some question about whether we have reached some singularity, to use the word that Ray Kurzweil popularized 20 years ago, where all of a sudden things are different on this side, where everybody talked about, for example, robots taking over the world, taking everybody's job. Well, that's pretty bad. If robots are taking over, they're doing a lousy job of taking over, because there's no robot takeover. Everybody said, oh, well, artificial intelligence are going to take over everything. Well, So far, they've done a lousy job of that too. But there is some debate about whether or not this kind of generative artificial intelligence that can actually generate human responses that ChatGPT represents is some kind of watershed, some kind of singularity where all of a sudden this is very different now. Judging by some of the early reactions, you can make an argument that it is. I can tell you I'm a science fiction fan, and I subscribe to a number of different magazines. There's a famous one called Clark's World, and the editor stopped submissions to the magazine last week. They have been inundated with artificial intelligence stories, not stories about artificial intelligence, stories written obviously by like a chat GPT, and they don't want artificial intelligence submissions. They've been inundated and they stopped submissions. And this is a major problem. We don't even know the implications in schools yet. They're still trying to figure that out. This seems to have created some kind of stir that has not happened before. So I don't know if it's a singularity. I don't want to get caught up with what the word singularity means, but this has definitely made a bigger splash than before. So let me just talk about stock picking and artificial intelligence. This whole thing is a little overrated because you get into an arms race on artificial intelligence and picking stocks. So the idea is, oh, this is great. I'm going to have an artificial intelligence. It's going to pick all the right stocks. I'm going to make billions. But think about this. Stock investing is a zero-sum game. You're only winning because somebody's losing. So the question is, if you get into an arms race, very quickly, everybody's artificial intelligence is going to be as smart as your artificial intelligence. So the outperformance is going to go down. We saw this in professional stock picking. Over the decade, as automation has occurred, electronic trading has occurred, the best traders, the professionals, all have access to the same information. So they don't have any informational advantage when they trade. They rely on people who don't have any, don't know what they're doing, including retail investors, to sort of pick them off. Well, when most trading is done by professionals, it's hard to outperform because everyone has access to the same information. The same thing will happen in an arms race with artificial intelligence picking stocks. Initially, there will be some people who notice anomalies because they have better AI, but eventually everyone out there is going to have AI, a personal digital assistant, and they're going to do stock trading. So this idea we're all going to make riches is crazy. It's not going to happen. We're all going to be equal in artificial intelligence very, very quickly because the systems learn fast. So here's a prediction I made a few years ago that hasn't quite happened, but I'll make it again because ChatGPT has made it feasible. I said a few years ago that in 5 years, 30% of the adult population will name a artificial intelligence, a personal digital assistant, your personal digital assistant, as their best friend. 30% of the adult population will name a personal digital assistant as their best friend. You know, already today, 20% of the adult population names a pet as their best friend. So once you start setting up, like if I have the Bob Pisani chat GPT and I start talking to it and it comes home, I say, hi, it says, how you doing? And I say, had a lousy day. And you start talking. Eventually that knows you better than your parents, your wife, and even better than you do. And eventually you'll start feeding it your tax returns, asking you to help out on your tax returns. And in 5 years, that thing's going to know everything about you. And it's going to plan your trip to Paris. It's going to help suggest how you talk to your mother about something unpleasant. It's going to do all sorts of things for you. So I think that has wonderful possibilities. I'd love some help, planning my next trip to Mexico because I'm always open to new suggestions. But I'm also terrified that this thing will know me more than I do. And already we see retail programs, people who track you on the internet that seem to know more than I do about me. So there's an arms race going on here. It's wonderful. We need more technology to help solve our problems. So I vote yes on all of this, but I'm also not some technological gee whiz guy. I'm a little too old. I know what the potential downsides are. So I am not afraid of AIs taking over the world. I'm not afraid of Skynet. But there are other things below that that are troublesome too. You have to be careful about. So I vote yes. I like ChatGPT. It's going to get better. It's going to get remarkably better. And everybody who laughs at it, who says, aha, you see, I asked it to tell me my favorite restaurants and the best restaurants in Bologna, Italy. And they gave us 10 choices, and 2 of them are not in Bologna, and 1 of them don't exist anymore. Aha, you see, it's a stupid system. You're helping train that system. Every day it's going to get smarter. The only thing I know for 100% is you're getting older, and that machine is getting smarter every day. And the next time, a year from now, it's not going to make that mistake because it will have learned already. Every day it gets better and better and better. Think about that. Those mistakes you laugh at, not going to make them soon. There's going to be a 4.0 ChatGPT coming out probably this year. This one they call 3.5. I think people are going to be shocked at how many hundreds of times better it is. And wait till 5.0 comes out probably next year. That's when you're going to get personal digital assistants. It's an interesting world we're living in, Katie.
Yeah, that is so fascinating. And I mean, it's crazy to think about how much things have changed in the last 10, 20 years, and to think about where it's going in another 5, 10, 20 years. I mean, it's just crazy. So we'll definitely see what happens there. But that's all the questions we have for this week. Thank you, Bob, for answering everything. Thank you to everyone who sent in questions, as always. And we'll see you again in a few weeks.
Thanks, guys. Great questions as always.
Yeah, thank you so much.